Why'd you do Twitch?
Because my YouTube said it needed 24 hours to set it up, blah blah blah. So I just did something else. I just want to be sure it's working. Okay, so um, let's see. Let's get the PDF up and probably okay. So what we're gonna do? You wanted to value Walmart, right?
Yeah.
So the spreadsheet that you're seeing, okay, is it's actually his spreadsheet, which I'll send to you
I've seen this one. This is on like all his newsletters. He does
on
this.
his all his newsletters. It's really a good one, and it's not too complicated. It's just got enough data. I find it the most useful. I've used I've used a whole bunch of other models of his, but this is the best one to use actually. So I haven't modified it at all except for the very end, this section here, which is called trailing 12 months. He has it also, but in his one, it's got limited information. I've added to the information. So, for example, oh, you like that? I've added a bunch of information to it. So, um, what we're going to do? So, really, you can see that it doesn't require a heck of a lot of data to, to do evaluation. Essentially, this is it here, and then you've got some lease information, R and
What's
D.
revenues last 12 months minus one?
Yeah, we're going to get into that shortly. So hold your horses. So what it says is sort of the top information. How do I do that? The top information is is sort of the most relevant information. As you get lower, it gets less significant. So what you do is you go out, and I did this already. Typically, I'll type investor Walmart because that'll take you straight to their investor page. Sometimes
Hmm.
it's a different, like there's stock.walmart. And so you go out there, and I don't know how much of this you've covered, but what you're looking for,
I've spent a lot of time here.
okay, so what you're looking for is the SEC filings,
Yeah.
which are down there. Oh,
Now
okay.
that's to get it to email. So if you go to the hamburger at the top left,
You've pulled these already?
I did it for something else where I was trying to pull their advertiser data.
Okay.
Financial information.
Yep. And so, what we're interested in is what's known as the 10Q and the 10K. So it's the 10Q and the 10K. And the K is for a year, and the Q is for a quarter. Okay?
Hmm.
And so the important concept is that you always want to get the latest data you can. And it's not always, that easy to get the latest data. So in an annual report, this is known as an annual report also. And so in an annual report, you get quite a comprehensive details. For example, they'll have a lot of footnotes that we will use. But in a quarterly report, they won't always have the finer details. So you'll sometimes get from the annual and you'll sometimes get from the quarterly. You don't always get from the same sort of place.
Hmm.
And what you're trying to do is you're trying to get what's known as the LTM, which stands for the last 12 months. Okay?
Hmm.
That's always your sort of goal, is to get sort of 12 months of data, but the latest 12 months. So that doesn't mean, so for example, Walmart,
We
if we
just
just,
finished their Q.
we come back to these over here, you'll see that they have a 10K over here. And the date of this 10K is, where is it? Fiscal year ending January 31st, 2019.
Yeah.
There. And so then if we look at the latest 10Q, now 10Q, you'd have them in quarters. So they'll issue one January, February, at the end of March. So a couple of weeks after March, it'll come out. Then April, May, and a couple of weeks after June, it'll come out. So you'll see we've got here, this one over here, which is the 10Q issued in July. So we're not worried about the one in between, the one that came out in April. Okay, we don't.
Why not?
Because I'm going to show you why not now. Let me flip back to the sketch to show this to you on a sketch. So the way it works is, if we're going to assemble the last 12 months, let's draw sort of a line. And if this is January 19, the first of this year, we can use the 10K, right? And the 10K has got data going all the way back to 118 for 12 months. Got it?
Mm-hmm. Mm-hmm.
Straightforward. So the 10K's data, it's reporting on 12 months of data. So it's reporting on all of last year, 2018's data, from January to December.
Yeah.
But we've also got this 10Q that exists. So a Q was issued in March 3, and a Q was issued the end of June.
Mm-hmm.
Okay? So that was Q1, and that's Q2. And so what we can do now, that becomes the latest data.
Mm-hmm.
Okay? But the problem is that they only, when you look at it, and let me
Not as detailed.
show you. It's not as detailed. This is it here, but if we just go to, let's see, the balance sheet, as I'm showing, you'll notice that the periods that it's given, is July 31st. And so it's reporting, well, a balance sheet's a bad example, and I'll show that why in a second. But let's go to an income statement. There we go. See that it says there 6 months ended July 31st.
So it has all that data.
So it only has 6 months of data.
Yeah.
So that's the thing, is the quarter two will report 6 months of data.
Yeah.
Sometimes they'll report also like 3 months and 6 months. But
Yeah.
6
They
months,
have that. They have 3 and 6.
Huh?
They have 3 and 6.
Yeah. So what we're trying to do then is to get 12 months of data, and this is the critical thing. We would want to break it here, because if we add 6 months from last year and 6 months from this year, we'd have 12 months of data.
Mm-hmm.
So what we're going to do is to calculate the last 12 months. There's a way you do it, where essentially you take the 10K's data. Let's put in some imaginary data. Say for this 10K, they're reporting revenues of 12 million. Okay? And let's say for this 6 months over here, they're reporting 7 million of revenues.
Mm-hmm.
What they'll also do is they'll tell you that for this, in this 10Q over here, they'll tell you for this 12 months over here, okay, they'll actually tell you what the same contrasting revenue was, because they contrasted in the report.
Here
it is. You can see they're saying, look, there's 2019 and 2018 for 6 months.
Mm-hmm.
And so it's very simple. What you say, and let's say they report there that it's 5 million. Okay? So what you're going to do is you're going to say 12 million. Where should we do it? Over there. 12 million, which is that number, minus 5 million. Okay? Because 12 million minus 5 million will give us that region over there, plus 7 million. and that's the last 12 months
Got it.
of data. So if we come back to our spreadsheet, you'll see right here that exact formula.
Mm-hmm.
B2 minus C2 plus D2. So B2, the last 10K, minus C2, the first X months of last year, plus D2, the first X months of the current year. And so that formula gives you
Last 10K. That's this one that was just done.
the last 10K is the 10K that was issued in January.
Oh, yes.
10K is for 12 months.
Yeah.
Minus the first 6 months of last year, January till June last year,
Got it.
plus the first 6 months of this year.
Got it.
And that gives you, think of it like a rolling
Yeah.
calendar.
Okay.
And so that's what this is all about, this part or this section of, what we're trying to accomplish here. So, what we're after is the revenues. And when you ask the question, what is LTM minus? Well, LTM is the last 12 months. In other words, from from June, back 12 months. LTM minus 1 is last year, June, back 12 months into 2017.
Got it.
So it's for comparison purposes, because it's going to
First
tell
a year
us.
ago. It's a year ago.
Yeah.
It's a year ago.
It's a year ago. So it's going to tell us what the difference is in revenues over a year. So the numbers that we're looking for are revenues, operating income, interest expenses, book value of equity and debt, cash and marketable securities, cross holdings, on and on and on and on we go.
And operating income is, what do you say, or EBITDA? Are they the same thing?
What do I say? What?
Or EBIT, a bit.
Yeah, earnings before interest and taxes.
And they're the same thing.
That's the same thing as operating income.
Got it. So this is just their revenues minus their costs, but before their taxes and their interest comes out,
That's
right?
That's exactly right. So,
and their cost, everything from the cost of the product, as well as like how to run their staff and all that stuff. It's basically anything to run the business.
Anything to operate the business. But so any financial costs are not in there. That's the difference. It doesn't include any financing.
But then he had this whole thing about how R&D is typically in there,
right,
and you can take it out, right?
That's right. So, and we're going to do that because you'll see down here, there's the R&D, and we're going to capitalize both now leases because they've just changed the laws this year.
Yeah,
and they've made them, because the accountants treated these things differently to the way folks would use them to value a company, and so they had to do this manipulation. But they've changed the laws somewhat on leases, so you've got some of the data being reported on the new law, but because you can see how we're stretching over years, only from this year, so only this year's 6 months, unless they go back and fix it, you're sort of dealing with apples and oranges a little bit on leases.
Got it.
So we'll look into that. But you're seeing that's why this is always useful to do. I also waited.
I don't know why that's the problem. He like just goes into each of the lessons, but then it's like he needs to tell the story first, and then
that's what I try and do with this stuff. So there we go. What we're going to do now is jump between the PDF. So let's sort of go after. Why don't I'll call out some numbers, and perhaps if you've got a pad or something.
They have it in Excel format.
Pardon?
They have everything in Excel format.
What does?
Their numbers, Walmart's earnings.
I know, but I find that to be So I've looked at that, and that's no benefit at all to that, because you want a PDF because you're going to do a lot of searching for keywords. Yes, you can do that but you want to look at the flow of this. And honestly, if you look at the number of numbers you need, it's a handful.
Yeah.
Probably 12 numbers in all.
Yeah.
It's very, very few. And, I don't. I think it's much better to do it. You don't want to read this whole 10K. It's totally boring. But you want to know where to find stuff. Like the art is how do you find stuff very quickly, and
Yeah.
how do you
Like,
use that
I
stuff?
found I found what they spend in advertising. Like that's what I've been doing now that I
Yeah,
came out of the business. I found out what like that's what the class has been nice. I've found out what they're spending on advertising, and then I put that in with the other revenues and stuff.
yeah.
So
Okay, so let's flip to the PDF now, and the first thing we're going to look for is revenues. So, you could.
what software is this that makes?
I don't like Adobe for this, believe it or not.
No, I
And
was asking about that makes you miniature on the left.
yeah, that's why I like it because the PDF that I use on the MacBook is tremendous.
Yeah.
It's got great, like it's got these little things on the left. So because this is on a Windows machine, I had to find another PDF software. I forgot what it's called, but it's very good. It's free. Um, all right, so revenue consolidated statement. Should have found it for me. I'm not sure why. Anyway, those are the search terms I use on my. Let's see, where are we? Consolidated statements of income. There we go. Okay, so there we go. Consolidated statements of income. And so I'm assuming you can read this okay?
A little bit. Yeah. You want me to type this?
No, I'll type it. Don't worry.
Okay.
I'll just flip to the screen. So the first thing we're looking for is the 6 months ended. So there you can see the comparisons,
Yeah.
2019 and 2018. And so the numbers that we're looking for are the total revenues, 254, 302.
Okay, got it. And I also see how they get to everything now.
254, 302. I'll flip back and show you what I'm doing in just a sec. And then for the last year was 25718. 257. Okay. So I'll just show that to you quickly on the sheet. Very straightforward. It's just these two numbers over here that I filled in. Just put them in. But of course, we haven't yet got to the 10K. Okay. But the way to do this is actually just to stay on the 10Q for the moment. Now, to get the LTM minus 1, you realize I've got to go to last year's 10Q. I've got to go to last year's 10Q to get that. So, you good with that?
Yeah.
So let's come back to the PDF, and I've got it lined up over here, and we'll do the same thing, consolidated statement of income. And so you can see here, this is 2018 and 2017. You see it? So this is last year, January to June, and then the 2017 January to June. So it's exactly the same, but it's a year sort of ago. So what we're going to do there is get the number of 250,717, which should ring a bell, right? It's the same number that they told us they reported in, obviously, because it's the same 6 months of 2018. They reported it on it. And then 240,897. Okay? So you'll notice that if we go back to the sheet, see how this 250,717, 250, it's the same number.
Yeah.
for obvious reasons. Because when they reported this is our this first 6 months of this year. This was last 6 months. This was the first 6 months of last year. And then when you looked at the 10Q from this time last year, and that's an important concept. I got the same 10Q, which is the second quarter 10Q. The 10Q that was issued on June the 30th this year and last year. Now there obviously is going to be a new one coming out in July, August, September, pretty quick. In the early October, there'll be a new one. Next couple of weeks. Okay, so we've done the revenues. Why don't we, just for completeness, switch to the 10K. So if we look at this 10K, you see there January 31st, 2019. So that was issued, their fiscal year is January 31st.
Yeah.
Wow. Okay.
Yeah.
That's weird. So actually I'm a month sort of incorrect, but it doesn't really make a difference. Just means.
What do you mean you're a month incorrect?
Well, I was always, when I was referring to you, I was saying that
got it. What you're
January,
saying.
February, March was their first quarter, because that's the norm. April, May, June was the second quarter, but it's not. Their first quarter is February, March, April, and then May, June, July is their next quarter. August, September, October. So they're still a while away from ending their third quarter.
Mm-hmm.
It's important to get your head around quarters, because that's kind of how they think. Okay, let's go to where is there? So this is their balance sheet. Oh, there's something that I should tell you about the difference between what happened. Okay, consolidated balance sheet, blah, blah, blah. And consolidated cash flows. Sometimes when I'm searching for this, I'll just search for terms that I know. Revenue, operating income. Okay, so this is obviously searching for the same word. I didn't realize that. Maybe advanced.
What are you looking for here? Revenue? Or you spelled revenue wrong.
I'm just looking for their damn income statement. Do you know what page it's on?
Mm-mm. Why don't you just write income statement?
I did. Let's see. Go to the table of contents. Financial data and supplemental data, and there we go. Statement of income. They call it different names, these people. Okay, so there we go. Fiscal year 2019, the revenues was 414,405. So we come back to this thing over here, and for the 10K, we're going to put in 514. 405. And so there the calculation is done for you to get you to your trailing 12 months of data.
And this is from his Excel, yeah?
What do you mean from his? This thing is the only tab that I change in
Got
his
it.
Excel. This trailing 12 months over here, I
Got it.
do change it because I found he has a bit of this data. I think he has this top section, but he doesn't really have this detail down over here. And so
Got
I've added it because it just made it easier for me to sit like in the evening, collate everything in one place, and off I go.
it.
And so this number here, 5178989, is really the first number that's required in the input sheet. And it's that number over there.
Got it.
And so what we're doing is we're working our way down through the sheet, which is essentially the whole valuation.
Yeah.
And really, you can see that I actually have a lot more data than he does on his front page, because this, as you get to the bottom, it's less fluid. It doesn't change that much. But so it's really just a couple of core fields. But the reason I have them is because it goes into working out cost of capital and more. You sort of, this thing works on a layer of detail, but there aren't more than 20 to 30 variables that get plugged in here. So should we keep going?
Mm-hmm.
Alrighty-o. So we come back to the trailing 12 months. And so now we got these two numbers, but now we need the last 10K for 20. So it would be the 10K that was issued in January 2018. Okay, but the benefit of that is that this one over here actually has that number. If you have a look over here for the fiscal year ending January the 31st, 2018, there it is there, 500.
Yeah.
So we can simply take that number, 500,343, and plug it in. 500,343 and plug it in. Now let me come back to this and let's see what we got. You see, notice this number's 510164, and the previous was 517989. And over here, I've just got a running calculation, which is looking at the difference, the percentage change. So there was a 2% change, because this is probably the most important parameter in valuation. Is like, what is my growth, right? I don't know if you've got to the lecture on growth, but it's really important because you've got to forecast the growth out into the future. So this starts helping you form an idea. Obviously, it's only 2 years, so it's not worth very much.
And he says that the intrinsic value of a company is the present values of the company's cash flows discounted, right? So
That's right.
but the cash flows, is that just revenues?
No. Let me draw that for you. No. So, whoops. When it powers out, it loses monitoring. So so this is sort of an important concept here. The way it works is that if you're looking at free cash flow to the firm,
Yeah, versus equity, right?
that's right, versus free cash flow to equity, that's where you have a different discount and you have a different cash flow at the top.
Calculation, yeah.
And the same for this one. They've got to match. So over here you're using your cost of capital, and here you're using your cost of equity. And over here for the cash flows, you're using your essentially it's your operating income. That's why EBIT.
And then the other one is operating income minus dividends and debt, right?
Yeah, this is net income essentially. Yeah. And so you're using different pieces. Now, this spreadsheet that we're looking at, he does it this way. This is the preferred way of doing it. And the reason it's preferred is because if you look at your income statement, okay, you know how it starts at the top with revenue, and then you have, cost of sales, and then you have sort of your that would be your operating income, and then you have some of your finance costs coming down. And so the thing is that the higher up you can view things, especially from a growth point of view, the more because if you think about it, as you go down, you've got more variables that have got different growth. So like
Yeah.
your finance may grow at one rate, your operating income grows at another rate, your revenue grows at another rate, your all these numbers here are growing. So you've got many different kind of growths
Yeah.
occurring, in different numbers. And so the more you can segregate it and have as few numbers as possible, and that's why we are focusing on operating income.
Got it.
And this is what his spreadsheet is doing. That's why you see there's only a couple of
Different.
things here. There's only revenue, operating income, and interest expense. That's all we're capturing from the balance sheet side of it, from the income statement side of things. And so that's why there's a difference. And so we're using this method. You can use this method, and he does in other spreadsheet models. He does, and I'll show you once you sort of wrap your head around. I've got a model spreadsheet that I've used all 4 of his models. He's published 4 models over time. And
Do you think he uses it based on like how leveraged the company is? So like we were knowing that.
no, because we're going to add leverage back over here.
Got it.
We have to take it because we have to get back from free cash flow to the firm. We're going to get back to free cash flow to equity. We're still going to derive that number because that's how you value your equity. So we're going to come back and we're going to look at the sort of debt, and we're going to subtract debt and do all sorts of things to get to that number. But it's just a much more accurate way of doing things, and it's you can do it the other way, and some guys do it, but he definitely prefers this way of doing things. So that's sort of how he tends to focus in on these things. So as I was saying, we've got like a 2% change over there. Okay, so now we're going down to the but you can see here the items that are that's all stuff from your income statement. Now, as you noticed in an income statement, you notice that over here it is it's for a fiscal year of a year, right? The way they do an income statement is they say this is in other words, 514, that's million, right? 514 million.
That's billion, I think.
Yes, billion. 514 billion, that's right. You add 6 noughts to all the numbers. 514 billion is what last year's revenue was for 12 months. When you look at a balance sheet, you say it differently. I don't know if you realize this, but it is important. Where is the damn balance sheet gone? It should be right here. Cash flows. I so much prefer the PDF reader in Mac. But anyway, here we go. Here is the balance sheet. So when I look at a number, look how it says the as of.
Yeah.
That word as of is so important because what that's saying to you is that as of on that date, January the 31st, 2019, the cash and cash equivalents I had in the bank was $7 billion, 7.7 billion. It's not saying for 12 months I had that.
No, it builds off of each other.
It's the balance.
Yeah.
That's why it's a balance sheet. An income statement is a cash flow.
Like a snapshot in time.
Period.
Balance sheets.
Yeah. And so that has important implications for LTM, right? Because this jumbly jupes we're going through here for working 12 months on LTM. You don't need that for balance sheet. You just got to go to your latest 10Q and get the balance as of June 31st. And that's the latest.
Wait, what are we getting? Sorry.
Okay, so let's come back to the sheet. I'll explain it another way. Notice over here, I highlighted the income statement items.
Yeah, that makes sense.
Notice that these over here have all got that funny formula.
Yeah.
Notice that the balance sheet items here do not have the funny formula. They don't need it.
Yeah. So okay. So I get the income statement. All that stuff makes sense. I don't really understand the book value of debt and equity. Yeah, but that we can get into.
Yeah,
I assume.
we're gonna get it. I'm just talking about the time periods. That's
Yeah. That makes sense.
the balance sheet. You don't have to go back and add 6 months and subtract 6 months.
Got it. Yeah, because it's a snapshot, right? Like it's the
That's it.
yeah.
That's it. So let's come back and finish up operating income. So we are now looking um, for these numbers over here. So again, we'll come to our 10Q, and so this is the 10Q for the 6 months ended July 31st. All right, so the two numbers that I've put in are these numbers here, 5583 and 5750, operating income. So you can see again here, you can see those earlier questions. What's coming afterwards is all the financing stuff
Yeah.
that gets you down to your net income. And it's this bottom part that's used in your free cash flow to equity. It's this top part that's used in your free cash flow to the firm. So we've got these two numbers here, and now we're going to go over to the 10K, and we're going to go forward, I think. Yes. Cash flows. Whoops. And where is that damn income statement? Restricted stock. Here we go. So we're going to go and get from the income statement, we've got the operating income is $21 billion for 2019. So we'll go and put it in over here, 21,957. And at the same time, we'll get 2018, which is 20,437. And then we'll go to finally the 10Q. We don't. And this 10Q, we've got the operating income for 2018 is 5750.
And so that debt represented there is debt just within that year, right? It's not
That's
their
right.
total.
Just
Yeah.
within that year. 5969. Five seven five oh 21,957. Five seven five oh. Oh, sorry. It's this. See the mistake. You got to watch this mistake if you're still with me.
Yeah, 1 second.
I took, be very careful because I published the 3 months and the 6 months
Hmm.
in income statements. So the last 3 months, and you got it. You can use either one of them, but you got to be consistent. You got to use the same one throughout. Otherwise, you're in
Deep
you
trouble.
that's a big mistake. So I've got to fix it up. I sort of wasn't reading properly. So for 2018, let me go in and capture that. The first X months of last year.
Do you think some firms have just like automated this?
Oh, you can automate it, and in honesty, I've automated it now. So I'll tell you about that in a second.
Well,
And
not on Twitch. Hudson.
okay, you ready?
Yeah.
So now what we can do is what's next? We're gonna do. Let me bring you back to the sheet. Show you where we are. We're gonna do the interest expenses, and those are fairly easy to get to. Um, let's go
And
and
that's basically, just to summarize, that's basically if they have a loan, that's the amount of interest that they pay.
yeah, they
The
have
total.
debt every year, and they've got to pay interest on the debt.
Okay.
And so that is disclosed where, do you think?
That would be in the balance sheet.
No, it's
No, well, I guess
it's part of
statement
your
for that year.
yes, it's
Yeah.
part of this is the interest income right down here.
And how would you get interest income though? If you give out loans?
Yeah, you can because they can buy. You know what they'll do with their extra cash is they'll buy um, securities like stocks,
Oh, got
but they'll also
it.
buy bonds that give
Got it.
interest, or you may have interest in the bank.
Yeah. So it's
So
like the saving. Yeah, yeah.
yeah. So now
But
you
they have
need
negative interest income.
what's that?
They have negative interest income.
Yeah, they have. So this is the interest that they treat it as a negative because but it's really income.
Oh, got it. I
It's really
see.
income because if you add these numbers together,
Yeah.
they're netting out the income. So it's the
Got it.
net. So see, there's a number there,
Yeah.
990. So in fact, what we're looking for is, let's switch back to the sheet, and your first 6 months of this year, okay, you want to tell me what the number should be? Interest
Well,
expense. It's 990.
yeah.
Okay, so that's not, and what's the number for the
And
first six?
990.
Huh?
990.
990. Yep. Oh,
You
sorry.
put 900.
Okay, you can't see the PDF. Sorry. And
Yeah, I
then
can.
the number for. Okay, hold on 1 second. I am on the wrong. So it's 990, and the other number is 1138. Cool. 1138. 990, 1138, and I just want to check my numbers. 11206 and 10904. Great. So let's gonna flip to the other PDF. You got to flip between these things the whole time, or you can just go down. Sometimes I do it that way. That's also much quicker. So this is for this year, 2019 and 2018. And so why don't you call out the numbers for me? So for the first 6 months in this year, the number is of net.
So interest net, right?
Yep.
Of 2019, 1210. Because the other one's 990, right?
That's right.
Obviously.
And the other one is 990. Cool. And so what we'll quickly do is now switch to the 10K. And we should see that same thing, the net interest. So what we're interested in is, oops, sorry, what did I do? There we go. What is the net interest for 29 this year? For
2129.
say that again.
2129.
And then for last year is 2178. Okay, great. So these numbers are starting to come together now. So we've got all these now figured out. And so now you onto the balance sheet items. Okay, so that's these next sort of couple of items here, which we'll get into. So the beauty of the balance sheet is, so after that, bit, which you can get quicker, you can do that in about 15 minutes once you you have everything sorted on your laptop and that. But the balance sheet items are a lot quicker because, as I said, you don't have to do all the
Just once, right?
jumping around. So we're just going to go to the very latest, which is, if you can see in the heading there,
September
10K
6th.
September 2019. So that's the very latest, and we're going to go now to the balance sheet. And so there's the balance sheet. And so the first thing we're looking for is the book value of equity. And so you obviously go down to the equity section, and the book value of equity is going to be this total shareholder equity number. Okay.
And what does that mean?
Okay, so what does book value of equity mean? Book value of equity means when they start the business, they invested, let's say, $100.
Yeah.
And every year that they made profit and retained money in the business, that book value of equity grew and grew and grew.
Got
So
it.
it grows with whatever you reinvest back into the business. And so that's what that is a measure of. At any particular one time, that's what the book value of equity is. Now, of course, the market value of equity is really the number of shares in supply times the share price, and it's different. It's much higher most times, because that's telling you how the market is valuing the equity. This is just everything at book value. So at the time that the cash flow money was reinvested, you just add it in to get your book value of equity. So it's not doesn't mean a whole bunch really, but it's sort of there. But it's sort of a baseline sort of number which you need, because it starts to tell you what your return on equity number is. And that starts to tell you if the investments that you make in the business are good investments or not good investments.
And it looks like their total, and you're looking at the total Walmart shareholders equity, right?
I'm looking at the total Walmart shareholders equity now.
Which went down.
Pardon?
Which went down from 72 billion to 7.
Yeah, and that'll happen because they that year they probably reinvested more.
Yeah.
That's $2 billion they reinvested in the business, or they spent in the business. So
Yeah.
that what that number means is pretty. It doesn't have a lot of meaning, but it's used in all the downstream calculations. So, for example, to get to your cost of capital, you need the ratio between debt and equity,
Got it. Yeah.
and they'll use it there. But he'll go and get the market value. He'll calculate what the market value of those are to get those calculations done. The only place you use the book value of equity and is in calculating your return on equity ratio.
Hmm.
Otherwise, they turn it into a market value. That has far more meaning because that's what the market currently would pay for equity in the business or for debt in the business.
Yeah.
So these are
And
sort of,
that gets you to your that cost of capital equation, right?
yeah, the cost of capital equation, which
Which
we'll,
is which is cost of equity and cost of debt, but then it's weighted by how much debt and equity the business
that's right.
has.
It's weighted.
But then the weighting of that debt, that's the market value.
That
That
the weighting is based on market value. That he does a calculation to get, well, it's easy to get the market value of equity. That you can just get off Yahoo right now. Let's do it, just for the fun of it.
But then what does the cost of capital get you? It's basically every time you invest, this is what you get from it.
No, just hold on 1 second. So we should be able to, there it is right there. Market cap. That's how much the equity is worth. That's how much so you can sort of make a comparison. That's 336 billion. And in the balance sheet, it is 77
Yeah.
billion. 70 billion. But that's how the market is valuing Walmart, and that's what the market is saying. Its cash generation potential is into the future. What we do in valuation is we get to a number that we can now compare with this 336 million to see if the market is right or wrong. That's all valuation is doing.
Yeah.
It's trying to ascertain, is the market right or wrong about that number, because it's all market sentiment.
Mm-hmm.
That's what's so interesting about it. It tries to put some, not science, maybe art, like he says, it's an art, a little bit of that art form around it. So, okay, we are, I think did you have another something you asked me? I can't remember
No,
now.
that's it.
Okay, so let's come back to the PDF. And in the PDF, we are looking for the book value of equity for this year. And so perhaps you can call it out to me if you.
Yeah. Give me a second. One second now. Can you see me?
Yep.
Okay.
All right, so give me the book value of equity for 20 this year.
Is it 7327? But is that 2019? I can't see because of the
7327.
7327. Yeah, but I don't know if that's 2019. You need to scroll up on the.
Okay. Yep. That's 2019. Oh, sorry. So you see how they've given July, June, July. So we want this column and this column, not the middle column, which you're good so far.
So 7327 and then 71185.
And then the book value of debt. Now that's an interesting one. That's got a little bit more thought because they scatter that around, okay, a little bit. So let's see if we can figure what that is. So we'll start, and you can call out the number as I call the line item. The first thing, so the definition of debt, right? He may have done that with you, but the definition of debt is obviously anything that earns interest. But more significantly, it's anything that if you default on it, they've got a claim on your company. They can effectively close the company down.
And so lease obligations are debt.
What's that? Lease obligations are counted as debt, but we count them in a different way. Although capital leases we will count right now, but we'll look at operating leases in a different way shortly. But yeah,
what's the difference between capital versus operating leases?
Yes, an operating lease is a capital lease is like to buy like equipment, and an operating lease is like premises, your facilities, that kind of thing. So capital leases they've always treated as debt. It's the operating lease which is more open to the discussion. They fixed it now. So on this 10Q, it should be reported correctly. But you know, like their one in their 10K in January probably wouldn't have it reported. Although because their financial year end was in January, I think it probably was corrected. So that's becoming less of an issue. But he's got a part of his spreadsheet does the calculation, and so we'll have to go to the footnotes to see how they handle it in a bit.
Mm-hmm.
But in the meantime, we'll just start collecting all this. The debt that we see. So obviously short-term borrowings is debt, so that number is
I'm trying to find it. 1 second. Oh, cool. 3681.
3681 plus.
And 44 in.
No, I'm doing a formula, so let's just stay on that column. And then the next thing we've got is accounts payable will not be, dividends will not be, accrued liabilities, accrued income taxes, long-term debt within 1 year is definitely. So what's that number?
4396.
All right. The next number would be operating lease. So you can see they've now included the operating lease. That number was not in last year's statements. If you go back and show you 10Q from last year, it would not be in there.
Yeah.
So they have now included it in there, and so they're including it as debt, and so we don't have to worry about doing it in the analysis the way he used to do it. So how much is that? The operating lease obligations?
1795. And is that if they own a store too? That's the lease.
Yep.
So it's like their mortgage payment on the store.
Yep.
Okay.
And then there's a financial lease obligation, 4395. Oh, sorry, 439.
439. But it's interesting that their operating lease obligations due within 1 year. Okay.
Okay, so that's cool, and there's nothing else.
But isn't that interesting that it says due within 1 year? So do you think the valuation needs to take into account multiple years or no?
Yeah. We got further year. Just the way they split it on a balance sheet. If you look down
Got
there,
it.
they've got long term. We're doing the long
Okay.
term right now. So there's long term debt. See it in the next line item.
Mm-hmm.
44,404.
Yep.
And then there's long term operating lease. So there it is, 16.
079.
Now, okay, I'll show you something interesting now. And then finance leases, 3915.
Mm-hmm.
And that's it. That's the debt. So you can see, oops, what did I do wrong here? I forgot to put a plus sign in. 16079 plus 39. So if I flip to this, you'll see I was writing out the formula there. Not the formula, just putting it all in one cell.
Mm-hmm.
All right, so we've got that number. And so we can now go and do last year, the same thing using last year's columns. So why don't we go do that for debt? And so the debt is...
So this is year ago now. Okay,
Yeah.
got it.
But you'll notice something interesting.
In the middle, there's something.
The middle is fine. That's not that interesting. The middle is just, it's just January. It's their snapshot of January. We couldn't care about that. We're interested in that one a year ago. But you'll notice that those same line items for operating lease don't exist. See, they dashes.
Got it.
And that's because they have just flipped over now. But it would have been nice for them to do an adjustment to show it to us. But they haven't been that kind.
They're lazy.
They're lazy. And they don't want to show you what it is, because it increases their debt. So let's go now into this year. So we've got short-term borrowings of 444
Yep.
plus.
Accounts. No, not accounts payable.
Yeah, tell me the next item.
Long-term debt due within a year
Mm-hmm.
is 1090,
Mm-hmm.
and then that's it. Capital lease and financing obligations due within a year.
Yep, all of that is anything that has
694.
got interest.
694.
Okay, now go to the long-term guys.
44958. Long-term capital lease and financing 6610, and that's it.
All right, great. So now we're getting. So what's your time situation? How do you want to play this?
I mean, I'm good.
You good? Okay, so we got cash and marketable securities. So let's go and have a look on this thing where you find that. And so there it is there, cash and cash equivalents. And then you'll just kind of look down to see if there's any other activities that relate to marketable securities. Sometimes I'll have them split out, but I think this is the number. Receivables, inventory, paid expenses, property, goodwill, other. No, there may be something in other long-term assets that we've got to go look for to see if there's marketable securities in there, because that's what they sometimes do. So anyway, let's start by the first number we're looking for is the clear cash number, which is 9283, right?
9283, yeah.
So 9283, and the last year's one is
15840. That's a big difference.
Cool. Yep. Big change in cash. which probably, so let's go and look.
Showing their reinvestment into the
Let's
business.
go look for marketable securities if they've got them tucked away anywhere, because they may be under these other long-term assets. That's the only other place that I can see that they could be. Yep. So other long-term assets. This is where good search comes into help, and I'm not sure why. Let's see if this search works better. I don't know what the difference is. Other long-term assets. Oh, this goes and searches in the documents. So normally the way I do this so that I don't have to read too much is I just scan through and I look for tables that could help me.
There it is. Oh. They say it.
Well, and then what you do is you go look for a heading, right?
Yeah, but it says it 0.7 billion of other long-term assets.
Yeah, but I don't want the number. I know what that is. I want to see that what's inside it. I want to get the details. Information on the fair value, the investments in. This is investments in other long-term assets.
I found that when I was looking at this for their advertising stuff, I found that they defined it in their 10K.
That's true. Let's keep going and just see if I can see other long-term assets. So it's $16 billion. That much we know. Yeah, there's not a whole lot here. Let's go to their 10K, as you say.
I'm just gonna get some water.
feel like there's some numbers that I'm not getting here, especially for this cash flow and marketable securities. They're just giving us, it's somewhere tucked away in these other assets. And that's where you've got to do a bit of hunting and searching, but maybe we'll come back to that one.
Okay.
We'll make a mental note to come back to it. So we are where on the spreadsheet?
Why don't we put it in the spreadsheet as a note?
Yeah, I'll just color code this.
What was the last valuation you did?
What have I just done? Can't remember. Yeah, I have them file, but I'll show you how different they are, the ones I do, because I do use some automation nowadays. So what you can see there, I do a I did some semiconductors, healthcare industries.
Oh, so you did whole industries.
Well, what I do is I look at the industries and I do a relative valuation to find out, just find some valued stocks there, and then the ones that look good, I'll do an intrinsic valuation.
Oh, that's cool.
Facebook was the last one I did, and I think Facebook is a good. I think I bought Facebook, if I'm not mistaken.
You did. You told me.
But the one that really grabbed my attention is not so much Walmart, because I did a relative. When you said to me, look at Walmart, I did, and then I ran an analysis on retailers, to see who would come, and the one that's sticking out to me is Alibaba.
Would you consider them a retailer, though?
Pardon?
Would you consider them a retailer? I guess in China, yeah.
Yeah, there are online I mean, I mixed online retailers with these. Walmart is not. In fact, Walmart at the moment is not showing. I did a quick valuation, and it's not showing. It's showing it's at value at the moment, maybe even a little overvalued to a degree. But I think their growth is hard to figure out. Anyway, let's keep going. Cash and marketable securities. How else can I dig these bad guys up? Not sure what the difference is in these two searches. All right, let's keep on moving. So the other thing you're looking for now is these sort of more interesting ones: cross holdings, non-operating assets, and minority interest. Now, cross holdings are where you've got a holding in another company, so where you own another company, but it's not wholly owned. So you get this concept of, if you own 50% or more, it's a majority. And then typically what you do when you own a majority is you consolidate all their data. Even if you own 60% of them, you put all their data you consolidate it into your books. and then you have an item in your liabilities called minority interest, which Walmart have, which you sort of subtract out because you don't own that 40%.
Got it.
And so they actually have that. It's that item over here. Because I noticed that when you were looking at shareholders' equity, don't know if you
Hmm.
noticed that.
So the cross holdings is like the asset, and then the minority interest is the debt.
Yes, but the cross holdings mean a different thing there to minority interest. Cross holdings is where you've got less than 50%, and you get sort of two measures, although they don't make any difference from a valuation point of view. You get if you've just got 0 to 20%, or if you've got 20 to 50%. And there's just different ways they handle it from an accounting perspective. But I haven't seen any of those sort of listed here. But what does stick out to me here is let's have a look. Where is it? I saw it.
The minority interest.
The minority interest definitely was there. Oh, let me show you where I am searching. So here in the assets, down in the equity, you'll see that we had non-controlling interest 6801, and I think that do they list it anywhere else? Minority interest, they sometimes put it in liabilities, but there is none here. So that non-controlling interest of 6801 is the number that we're looking for over here. Okay?
Mm-hmm.
And non-operating assets are assets. Obviously, we've looked at everything to do with operating, right? That Walmart
Assets
use.
don't help
Like,
them generate a profit.
yeah,
Or,
all the assets we've looked at are sort of stuff that they use to do business. But sometimes they'll have like weird assets like paintings, artwork that have nothing to do. If you've got an office building where people are sitting in, that
yeah,
office building is not considered. It's considered to be part of your cash generation. That's what enables you to generate cash. And so you don't
yeah,
want to double count it because you're counting it all in the cash flows.
yeah.
The principle of valuation is measuring cash flows. That's all we're trying to do. So you'll be double counting
Wait, so
if
the
you,
office building isn't the office building a lease expense, a long
well,
term lease?
but let's say you own it.
Yeah,
Yeah.
then
So
it's an asset.
yeah, it's an asset, but it's already coming into your cash flows because you have to have that retail space to generate cash flows. So
Got it.
you don't count it as something that you add into the valuation.
Meaning, meaning
Because
if you
when you
didn't
do,
have, if you didn't have it, you wouldn't be able
you
to
wouldn't
generate.
you wouldn't generate that much cash flows. Your growth wouldn't be. And we are doing a present value on cash flows. So we don't want to double count the things that are contributing to cash flow. So non-operating assets are assets where they've got nothing to do with what you
Yeah,
may own. Like even a jet would be an operator because it moves your executives around. But if you have artwork that somehow you had them, and like the famous case he uses always is the Playboy mansion that Playboy had, where they had the I don't know, the old owner used to live there and he had a right to live there, and it does nothing for their cash flows. So you have to
okay,
count that asset extra and add it to the value of your company. Makes your
okay.
company more valuable. But there's clearly nothing sticking out like that to my knowledge. And then in cross holdings, you would normally see something to the effect listed in the assets, either short-term assets or long-term assets. Um, but nothing here is glaring. So the way I read this is like the only number that's worrying me is really this other long-term assets.
Mm-hmm.
And I wish I could find the note. If I was sitting down and probably using my MacBook, I would find it in a second. but there would be a note. They normally have a note that says, this is what it is. Let's try and search it one more time. Because I think there's stuff tucked away there. The company has equity investment and its investment in JD measured at recurring basis included in other. That's what was worrying me. So it's right there. They've invested. You know who JD is? JD.com.
The Chinese company, right?
I thought it was India, actually.
Okay. And the balance sheet balances, right? Because whatever's left over in the assets because of their cash flows, they'll give to their shareholders, in theory. Right? So basically, it's like because the liabilities and the assets need to equal each other and balance out, and then anything left over is what kind of goes into their dividends.
Yeah.
And that is a liability.
And if they don't pay dividends, it'll just go into that book value of equity and swell it.
Got it.
Okay, so let's try and find this other long-term asset of theirs. The fair value of JD is as follows. Looks like that number there. What's this? They've also hold some derivative instruments. So I think to the best of my knowledge, that number over here, this is where you get into the more nuanced, this is where you got to do this a lot. Because you start seeing these patterns. But to my knowledge over here, this fair value of 3431 is the number that we're looking for to add into this thing over here. Let's see what it does. But I suspect that feels like it's not accounted for and it needs to be in 4314. Maybe. Feels directionally right. And then they've got 10 million in derivatives, but the fair value is like nothing. See there? What you're interested in is the fair value. It doesn't seem to be relevant. And then they have
other derivatives.
Seems like they have something down here. The assets of a disposable group totaled 3.3 billion. 1 billion in current assets in property and equipment for Walmart Brazil. Alright, let's just call that the number for now. Now we didn't, so what I did is I added that one. I added that 4314 there. But for the first X months of last year,
we don't know.
I can go back and I can quickly get that. I don't know. All right, I can't seem to find anything for last. Go back to this thing. Do they have current assets, inventory, cash and equivalents? They don't have other current assets in last year's one. Wonder why. Okay, that's the best information we got at this point.
Okay.
So let's keep moving.
So if they don't have last year, do we include it or no?
No, we don't. And it's not that important. I'll show you why. I'll show you why now if you like. Really, the most current is important, and I don't even know why we get the book marketable securities. I don't know why we get last year's number, but it doesn't play any part. If I delete that number, it has no significance in the sheet that I recall. Anyway, okay, so we keep going, and we are. We are. I'm just busy. Just now. We are on the number of shares outstanding, which is this one over here.
That's easy.
And that one's easy because that one you go out to the
Yahoo, yeah,
and you get it. So they normally list it very close here. I used to think. Financials. Should we look in there? Total revenue, cost of revenue. By the way, you could, if you wanted, to get the numbers from here too. If you didn't want to hunt and peck around, nothing to stop you doing that. To do it, sometimes you could do a quick analysis. But I don't see statistics.
Alright, guys.
Normally they show it to you right here. I mean, you could get it quite easily. I could just divide that by their share price. So what you could do, but let's just go some. Pardon?
You want me to Google it?
Yeah, we'll go now to Walmart, Google Finance. One of them's got it.
Jesus. I always normally see it. Oh, look.
Oh, it's in statistics, of course.
Shares outstanding 2.85 billion.
Where did you see that?
In Yahoo Finance, but I don't know what date it is. 5. Shares outstanding is taken from the most recent filed quarterly or annual report.
Okay, yeah.
Market cap is
Here it is, right here. 2.85 billion. So the way you got to write that is 2,000. 1, 2, 3. Wait. 2,000. Yeah. You agree that's 2.85 billion?
I guess if you add 6 euros to it, 6.
Yeah. 6 zeros. That would make it 2.85 billion. So it's important just to recognize that's how the sort of convention here is for writing. And then what's the stock price? I can get it.
118.45.
All right, so we're getting to the final leg of our journey. Some of the journey, not all of the journey.
Yeah, because we still have to do the beta and stuff.
Yeah, so this is like sort of the interesting part, because you can do it in a couple of ways. Like you can also you can get the cost of capital from like an average, from the industry average.
Yeah.
That's how I do it, and I use that just to get it, because it's always nice to know where you are with the current numbers. And then you go and do your cost of capital right after that. Because he gives you a whole lot of industry average numbers that you can use.
But I've looked at those, and most of them are so outdated, though. But maybe, I don't know, maybe they're in a different location.
But you'll find that, if the cost of capital is 8% versus 9%, not going to make a big difference.
A big difference, yeah. That's
the biggest difference to your valuation comes in how he estimates the terminal value. Have you done that yet?
No, that's next classes.
Because if you think about it, like, how long should we project? Okay, so let's just take a intermission.
Like how long do you do the valuation for?
Yeah,
how long?
Like this sheet. This is basically the output sheet of his whole story, and the question becomes, what are you trying to do? Just think about it on a basic level. You're trying to figure out this number over here, this free cash flow to the firm, going out for 10 years, and then you've got to say to yourself, well, how much further must I go out for?
Yeah.
And you're trying to say, okay, now let me get those numbers and I'll discount them, which you can see him doing here to get his present value for each one of them. And then he adds those together, and that's basically how he gets. It's very simple stuff, really.
How does he get the discount factor by the cost of capital?
Yeah. How you do that? Let me.
Can I see the formula?
Huh?
Can I see the formula real quick?
But I can also. It's probably better to explain it. So the formula is just 1 over 1 plus the cost of capital, right? But what you do is each time you go a period, you've got to take the previous periods and multiply it by the current one. So you take this number and you multiply it by that. But there's the reason for it. Let me show that to you quickly. The reason for that is Sketchpad.
And I noticed the cost of capital changes.
The cost of capital changes because that's what happens in the real world. So the way this works is that if you look at your basic formula, you've got your cash flow 1 divided by 1 plus R.
And R is the discount rate.
And R is the discount rate. And then you would go into your cash flow 2 over 1 plus R squared.
To the second. Yeah.
Okay. Plus cash flow 3 over 1 plus R to the 3. And you'd go on, doing that until this sort of terminal value. And how do you do that? So that's a separate discussion. And so you can see that, if your R was the same throughout, then it becomes, a much simpler calculation.
Yeah.
But because R is changing, really what this really means is that C3 divided by 1 plus R in period 1 times 1 plus R in period 2 plus times 1 plus R in period 3. So that's why you've got this what that factor means, because what he does is he says, like, what's the first, let's come back to the sheet. So it's 4.82. I'll just write this down for a second. 4.82 and I don't know, 5.06, and another one is 5.31. So if we look at the sketch pad, it's he says 1 over 1 plus 4.82, and so he figures out what that number is, and then in the next period he multiplies that by 1 over 1 plus 506. And so he just keeps this sort of running total going. It's just like a simpler, not a simpler way, it's just an easier way to explain it.
Yeah.
Because if you go down here, you'll see that he says H3, 13, which is, if I highlight it, it's that, times 1 over 1 that. And that one, so each one of them has got all the previous in them. And then he just uses that as the division or the multiplication. The reason he doesn't divide it is because he's done the division already there.
And then if you sum up those present values of the cash, that will give you the valuation, and divide that by the total amount of shares.
Yeah, he does a bit more. So then what he'll do is he'll say, first of all, he'll do the terminal value, which is the formula for this box over here. Okay. And then he'll get the cost of capital, and this is all to do with the terminal value. But notice how big look at that, it's $203 billion. The present value for the cash flows over the first 10 years is $121 billion. So it's half. Mm-hmm. The first 10 years of all this work that we're doing is half the cash flows.
Yeah.
Or the present value. And then the second, so altogether gives you $325 billion. And then what he does is he takes off the debt, subtracts the debt. Okay? Because that's an important part of how you get from free cash flow to the firm to free cash flow to equity. You've got to take off the debt. And then the minority interest, if we haven't yet filled it in. And then he adds back the cash. If there were any paintings or that stuff, he gets to that total, and then he divides by the number of shares, which we've just calculated. and he compares it to the price. But let's keep swinging for, let's say, let's try and get everything before cost of capital if we can.
Okay.
And then we'll do cost of capital at another, whenever you want.
We can do it tomorrow.
Do it tomorrow.
Rachel's at her Pilates things. She's in her training.
Oh, she's learning how to do it?
Yeah.
Okay, so we got down. So now we're going to just work out the taxes. There's a difference between effective tax rate and marginal tax rate. Okay?
Yeah.
Your marginal tax rate is what the government. So the federal tax rate for
Additional good, right?
is 21%, and then you've got state taxes. So he averages it out to 25%, which you see there.
Got it.
But most companies have an effective tax rate which is different. Why? Because they've got deferments. They may have losses carried forward. They can have all sorts of circumstances that make that rate different. And so what we're trying to do is just figure out on average, what that rate sits at. You can, and you'll notice it's been done here with the LTM method, because income before taxes and income tax expenses are from the income statement. So we're going to go get these numbers from the income statement, and just try and figure out what they're effectively paying. You can also look in the thing they actually disclose it. They say their effective tax rate currently is this and this, but I, for whatever strange reason, like to go and calculate what the number is, and figure it out. So we're trying to get what their effective tax rate is. So what we're after is the income before taxes. So let's jump to the PDF. All right, so here we are on the consolidated statement of income, and you can see there's an item here, income before income taxes. Couldn't be more simpler. Can you keep your eye on that one and give me the first 6 months of the current year?
10,070. 6 months ended July 31st. Yeah, 2019.
And then the first 6 months of last year.
3,220. Wow, big difference.
Yeah, that's what happens. And then there should be something called actual income taxes or provision for income taxes, which is the next line item. So could you
6 months 2019, 2,484. And 6 months 2018, 1,671.
All right, cool. And now we've got to go to the 10K.
Weird that they lost money for a quarter.
No, that happens often. And the reason could be not because of a negative thing. It could be because they spent a lot of reinvested a lot of money.
Yeah.
Did a lot of, maybe they did store acquisitions or things like that. Okay, so again, we're looking for a 2019 number for income before
11,460.
I feel like I did something. What is it?
11,460.
And then income taxes. Provision for income 4281.
4281. 2019, yeah?
Yeah. Let me just check something. All right. So if we look at the sheet now, you'll see that the effective tax rate is just the number, those two numbers divided by each other. 4281 divided by 11, so 37%, 51%, 24%, 27%. So 27% is sort of the trailing number where it is. And so their taxes are actually going to be coming down.
Yeah.
Okay, cool. So I think what we'll do is we won't do the leases and R&D for now. We'll come back to that. I think what we're going to do is start transcribing these numbers. How can we do it so that you can you take a screenshot of that?
Mm-hmm. What do you mean transcribing them?
I'll show you now what I mean.
We're going to input them again?
Yeah, and that's why you've got the screen. You can call them out. I'm going to flip to the screen. And
do they not feed into there?
No, because that you can make them feed in if you wanted to. You know, it's just a simple formula, but it's just done separately. As I say, I've automated a lot of this.
Yeah.
But for the purposes of learning, you don't want to automate anything.
Yeah.
Because otherwise you got to let your fingers do the walking here and you learn it. Okay, so give me the revenues.
Trailing 12 months.
The LTM revenues for this year.
517 989.
Okay.
Then revenue last 12 months or what?
No, not the last. Yes, the last LTM minus 1.
Yeah. 510 164.
Okay, cool. And then the operating income?
21581. No. 21581. Two one 581, yeah. Then what do you need? Last 12 months minus 1?
Yeah.
20135. Interest expense is 2349. And the interest expense last 12 months, 2030.
Book value of
Book
equity.
value of equity in what, last 10K or last?
Last 10K.
7327.
And the one before that?
71,185. And then the book value of debt is 74,709. And then the one before that is 53,796.
All right, for the moment, I'm going to say no to operating leases, yes to R&D, although we haven't got the R&D numbers yet, but don't worry. Cash and marketable securities.
13597.
135.
597. 15840.
And then minority interest.
6801.
Number of shares outstanding.
2850.
Stock price.
11845. Which is there.
The effective rate.
Trailing last 12 months, right?
Mm-hmm.
2782.82.
27.82.
Yeah, for the last 12 months. Yeah, and then the marginal's 25.
Yeah. All right, cool. And then we knew that the thing was okay. So let's now understand a couple of these variables. So
I mean, these numbers, these assumptions drive the full valuation.
yeah, those four. Crazy, huh? So let's now come back and look at the first two numbers. So as you remember, we looked at
2% growth.
Yeah, but we obviously 1.53, and then the margin. You know what the margin is? There's the formula.
Yeah. It's your profit, right?
It's your profit margin. So it says it is. If I highlight it for you, it is.
That's small, huh?
21. Yeah, it's small. Like tech companies, you know,
high.
they can do 30, 40%, sometimes even 60. But these guys work on thin margins. And then, yeah, so that's 4.17%. So those numbers are sort of driving.
Interesting how thin their margins are. I wonder how reactive their advertising is, right? Because the thinner the margins, right, like you need more flexibility in your advertising spend.
Yeah. So, you know what, I don't know what this, let's make this 2% and 4% just for the moment. And then the year of convergence is basically, he tends to use this for most of his sheets, but what it is it says,
where the cost of capital changes.
I'm going to grow for 5 years at 2% on average. And then I'm going to bring it in to 1.56%. Now, 1.56 is your risk-free rate. And the reason he does that is he uses that as a surrogate to say, look, for the 11th year onwards, I can't grow you at faster than the economy, because then you become the economy.
But is that the only place he uses? Is that where
he uses it elsewhere?
Where else?
It's used in the cost of capital, in the calculation for cost of capital.
Okay.
It's used in quite a few different places. So we'll keep that at 5, and then the sales to capital ratio, which is getting over there also, B8. So B8 is revenues. Okay. B8 is revenues. Sales divided by capital. This is this is his made up number. Not that I look at many people in the literature, but I don't believe there are many people that sort of use it. But he divides it by B39, and B39 is your invested capital. And if you look at your formula for invested capital,
it's based on the R&D.
Well, it is based on, I don't know, I can't seem to work my mouse today. There we go. So it's quite a complicated formula, but it's not really that complicated. So what he's doing is, in the beginning here, he takes cell 11 plus 12 minus 15. And what that is book value of equity debt, cash. And so he says, he adds those two and he subtracts out cash. And that gives you your classical, what's the capital of the business? Because cash is not considered part of the capital. That's why what you do when you do valuation is you take cash out completely, almost like it doesn't exist, and then you put it back at the very end, right over here.
Yeah.
Right over here. So everything you'll notice has cash subtracted out. So it takes book value of equity plus debt, because he says this is the capital we've got to operate in. We've raised capital, we've raised equity, and we've raised debt. And so he says that's what it is. Then he does his adjustments for operating lease and R&D, which we'll get into a bit later. But essentially he adjusts it by those amounts to get those amounts. But he says that's my invested capital in the business. And what he does is he says, look, if I can get a number, sales, okay, which is, where's sales? 517 billion. So it's going to be sales divided by book value of equity plus debt minus cash. And he does that calculate, and he gets this number of 3.94. And why this number is important is because he uses this to calculate reinvestment. Okay. And the reason he uses it, because it's very hard to look at historic reinvestment. If you go back and look at what these guys have reinvested in the company, which is essentially your capex, which we haven't even looked. You notice we didn't look at that at all.
Yeah.
This is where it all feeds into you. And let me show that to you in a PDF quickly. It's in the cash flow. That's why this is one part. You'll notice, interestingly enough, we never looked at the statement of. You've got three statements, and one of them is your consolidated statement of cash flow. Cash flow looks at just how the cash has flown in and out for the year, also over a year period. And you'll notice that in here, you're going to have somewhere, there we go. Payment for property and equipment. And you're going to have proceeds from disposing, and then proceed, and in any acquisitions that have been done. That's that amount there is known as your capital. That's what you've had to spend money on this year, your capex.
And that's negative 56 because I guess one of their businesses was acquired or sold.
No, that's money going out. That's what you've spent. It's cash going out. That's why it's negative.
Got it.
The positive is a proceed, because you sometimes you'll take your assets and your trucks, you might sell them. Yeah. And so those numbers there are your, but again, I'm looking here probably at the 10K, so it's for 6 months only. So, but it doesn't matter what that number is. You could go now and add those numbers from the 10K. And you could figure out how much is my capex, right?
Yeah.
And then you subtract out of that your depreciation, and there's your depreciation right there.
Yeah. But he's saying historical, it's not the best to do.
The problem is if you look at those numbers, historically, they're all over the map. Yeah. 1 year they're like $1 billion, the next year they 200, the next year they 10 billion. And so what do you use going forward? He uses this ratio to give it to him. So, you'll notice he's probably, let me use my new technology. You've probably noticed that he always says that investment, I don't know if, hopefully he's done this with you, investment equals capex minus depreciation, okay, plus the change in working capital. And we just looked at capex just a few minutes ago. That was made up of like property and acquisitions, okay? And so you add those, you subtract out your depreciation, and then your change in working capital consists of however much your receivables, accounts receivable, has increased by, because you need to fund accounts receivable.
Mm-hmm.
And then however much your accounts payable has decreased by, and then however much your inventory has increased by. Because these are all investments, cash that you needed this year. You needed to make cash. You needed cash for all of this. You needed to buy this stuff for your business. And this is what's called your investment. And it's a number. And the problem is this number over a period of time historically is all over the place.
Mm-hmm.
It's like crazy. And so you can't really, it's very hard to forecast what it's going to be. So he's gone ahead and he's used this ratio of 3.94 over here. And how he uses it is as follows. See that line item, reinvestment?
Yeah.
That's the secret sauce, man.
Got it. And then he got to that by the sales. If you go down, right? That's in the chart below.
That's
right?
It. You want to see the formula for that? Formula is very interesting formula, in my opinion, anyway.
The revenues minus
revenues on 1 year minus the revenues of the previous year. That gives you the change in revenues. How much revenues increased or decreased. Okay. And he divides that by that sales to capital ratio. And that gives you the amount of capital you need.
Got it.
It's the heart of it, sort of the heart of what makes this model tick. It's understanding that. Took me quite a while to get and I sometimes have to ponder it still. I'll sort of write the formula on the board for you. So what he does is he takes revenues in like this year, minus revenues in last. So let's say this was 200 minus, I don't know, 150 equals 50. And then remember we had that number called sales to capital, which was 4 or 3.75. And what that really says to you is that if he then divides 50 by 4, okay, that's going to say 4s into 50 go what, 20, I don't know, 12 times, something like that. And that's capital that you'll need. That's reinvestment that you will need. That's how much you need to reinvest in your business.
But then doesn't he have to take into account the return on capital for the next year then? Does he take that into account and factor that into the growth of revenues? Because if they're investing capital, they should get a return on capital, and then that return on capital should flow through to revenues, which should help grow the revenues.
That's right. And he'll do some stuff a little bit later where he looks at your return on capital and he'll see if it's a viable number or not. But this reinvestment is sort of very key. And so you can see there it is coming in there to the spreadsheet. And it's all based off this variable right over here. And so I'll send this to you. Well, let's just finish our risk-free and cost of capital. And then you should play with this a little tonight, these numbers, and sort of change them and see what it does. Like what I like to do is actually put the value here. So that's easy to do. So right now the thing is at $82. And you can see that if I make this, if I increase the sales to capital, if I make it a bigger number, what that really means is my reinvestment's going down. That means I'm going to have more free cash flows. Now that's probably your mind's probably exploding at that, but you should be able to get your head around thinking about this, because then you've got it. So if I make this 5, I think that number should go up. So it went up $1.
Dad, I can't see the.
Oh, sorry. Shit. So what I did, firstly I copied this number, the actual value, into the cell just with the formula. And then I changed this from 3.94 to 5.
Mm-hmm.
And there's the number changing.
Okay.
So that's how you play with it. So you can see that if I make, but right now it's not looking too healthy.
Mm-hmm.
But let's close down this discussion with a look at risk-free and cost of capital. And we'll use an inaccurate measure for now. And so the risk-free is quite easy to get. It's more difficult to...
It's difficult in the other countries.
Oh, what did I do?
Because you have to take into account all these other bonds.
Did I stop sharing?
Yeah.
That's crazy.
You should put this on Udemy.
I'm thinking about it. Okay, I think all sorts of technologies. Okay,
I can see behind the curtain.
What?
I can see behind the green curtain, the facade.
Can you?
Yeah. We can do tomorrow if you want. I mean,
I think this is a signal.
Yeah. Okay.